Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at this disclaimer being shared. Market Chameleon, Dimitri, or myself, none of us are registered investment advisors. If you need investment advice, please search out your broker-dealer for any investment advice. One more look at the disclaimer, and here we go, Dimitri. How you doing?
Good. How are you?
Great.
All right. Let me share my screen. And if you're joining us for the first time, welcome. Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data or the analytics. So it's really an attempt, for Q&A. If you have a question, and type it into the live chat on YouTube. Will's watching it. He'll read it back to me. And to give you a couple minutes to type those questions in, we're going to start out taking a look at our pre-market report to see if we could get insights, what's going on in the pre-market hours, and then we'll move on to the questions. So on this pre-market report, up top, we have this calendar view, and you see the last weeks of pre-market summary statistics, just to see if there's any type of trend or something unusual. You could really eyeball this. Today we're on March 14th over here, and we could see here that so far today we got 518 stocks trading higher, 318 stocks trading lower in the pre-market. There are 115 million shares trading on up volume versus 68 million shares trading on down volume. And if we convert the volume to dollar value, we have $2.3 billion worth of stock trading higher versus $2.7 billion worth of stock trading lower. And I think so far, it's given us a little bit of a mixed bag. More stocks are higher. The dollar value of the stocks trading lower exceeds the dollar value of the stocks trading higher. So a little bit of mixed signal there. Nothing's pointing to overwhelmingly bullish or bias. By the way, if you do want to go back to a historical date to look at what happened to pre-market hours, you can use this calendar or drop down this date box and select a historical date. Before we move on to the questions, let's look at it from a couple more perspectives, and then we'll go on to the questions. So I'm going to scroll down here, and now you see a more granular view of what's going on in pre-market hours. This shows the stock symbols along with the price changes in the pre-market hours, market cap, and also any kind of alerts. So we could see here we have a list of our most active stocks, a list of our biggest percentage gainers, and a list of our biggest percentage decliners list. We have 55 stocks that made it onto our largest gainers list and 66 on our largest decliners. So that points to a more bearishly in the pre-market hours. Now, to make this particular list, we do set thresholds for price moves, liquidity, volume, and all these things, because stocks in the pre-market tend to trade with sometimes very low volume or very low liquidity. So if the stock does meet our threshold, it could make it onto this list, and that includes small cap stocks. You can see there in the market cap section, there are small cap stocks in here. It could be an ETF, could be an inverse ETF, a closed-end fund. So any security that meets those conditions can make this list. And to narrow down this list to a small group of stocks, we could use the filters above. If you have a watch list, you could filter by your watch list. So if you like to track a certain group of stocks and you created that watch list, you could use that on this filter and filter out those stocks to see if it hit the pre-market report. And we're going to use this filter in our example in ETF to show you guys how that works. I'm going to click on that filter. You get a drop-down menu to select from. we're going to choose SPY, which is the SPY ETF. When you click on it, the stocks below get filtered by holdings of the SPY ETF. So it has to be basically an S&P 500 constituent. And here we have 6 stocks that made our largest percentage gainers list and 4 in our decliners. So that's slightly bullish. I guess we could say, or really, I would say everything's so far kind of pointing, nothing overwhelmingly points to any one direction. So let's just call it so far, pretty balanced trading activity in the pre-market. I gave it a couple minutes. Well, if we have questions, I'll take those questions now.
No questions, but quite a few people were talking about different things they've been doing. I know we have that great new feature that you can look more in depth into what's traded in the spread market. Mike's been asked, but
okay. We can take a look at NVDA here. And we're on NVIDIA now. We could go under the options and take a look at the multi-leg trades. And these are multi-leg strategies over here that we captured in NVIDIA for yesterday, this March 13th. We're not open yet, so these are end of day yesterday. So if I click on there, you could see that NVIDIA here, there are 66 different types of strategies we detected. If we open that up, you could see here they're sorted by volume. So there are 289,000 contracts yesterday that were part of a multi-leg trade, out of 1.4 million. And we detected 7,954 unique combinations. Okay, so what's a unique combination could be? Well, here in the call spread, we had 2,224 unique combinations. Unique combination could be, call spreads in different expirations, or a call spread with different strikes, right? So if you have 2 different strikes in one call spread and the strikes in a different call spread, even within the same month, the strikes are different, then those are 2 unique types of spreads. So you could see quite a bit of unique spreads coming up here. And, just looking at the top ones, the call spreads were the most popular. Then you got put spreads. So you could see 85,000 contracts in the call spreads, 79,000 of put spreads. And then it kind of you could see the other ones drop off, as far as volume goes significantly. You got a ratio call spreads, 21,000 contracts, 242 different combinations, call butterfly, diagonal call spread, and so forth. So if you're just, interested in a particular type of spread to analyze in the stock and you see some trading, you could click on this. Like if we wanted to look at which call spreads traded, could click on that. And now it brings up the call spreads. There are 207. So it shows the top 5. You could expand it or go back, using this. And we see the biggest one here so far was the March 15th, 970, 1,130. So you can see 2 days left till expiration. These strikes are $30 apart. 970 to 1,000, 1,000 to 130. Let me just say here, it says that this spread, this call butterfly, historically traded 8 other days. So when I open this up, these are going to be today's statistics. So these are all the details if we wanted to see today's trades, different prices, different times, and they're zipped up. If you open it up, here's the time in sales. Let's see historically. So we could see here that from February 23rd, this traded, on February 23rd, only, 8 contracts, 56. It got March 7th, we got 4,848, March 8th. So, if we open that up, we'll kind of see here, this is traded, and you can see how much the open interest increased. But really, yesterday was the most, 6,000, and maybe, it could be closing out of these 4 and 8. You know what? Let's take a look. So 6,000 contracts total traded. So you could see here 1,500 on the 970 line, 3,000 on the 1,000 line, 1,500 on the 300. And the open interest did increase on each of these. So we'd have to kind of see what else traded there. It's inconclusive. Maybe this was adding to a position because we didn't see a decrease, but it's inconclusive because it looks like there's other stuff probably trading. And I'm sure NVIDIA, these strikes are probably popular. So, what I wanted to do? Well, actually,
Hey, D,
yeah,
we did have a question pop up.
yeah.
When you were going through the NVIDIA, Zoom asked, is there a way to see the back test results on a call spread from NVIDIA? So I guess if we're looking at one of those call spreads, how would you see what it's done in the past? Is there a way to see it?
So as far as it's not like, I'm not sure if he's saying a back test or he just wants to see the price graph of a call spread. How did this call spread do?
Is there a way to see a back test result on the call spread, was his question.
Okay, well, the way you're wording it, no, because there's no way to do back test of a call spread. You could just see the history of a call spread, or you could do a back test of a strategy, for example, but you'd have to define the strategy and what the terms are. But back test of a call, it's like saying, can you do a back test of a stock price?
I guess
what is the strategy?
That call spread, you can take each piece of it and put it in a
yeah, it's a confusing question, but
yeah.
What we can do, is maybe set up, this call spread. Let's say, so March 15th, 910, 920. Okay, so let's just go over here on the options chain. And it was in March 15th here. We'll just take a look at it. So we got the 910. Okay, and I'm just going to set it up as a bulk call spread, 920. All right, so here we can see March 910, buying the 910 call, selling the March 920 call. And I'm going to leave these prices in. I'm not going to change them. We'll just leave it as the market, 1690 on the call if you're buying it on the offer. And then the March 920 call, we'll leave selling 1260, which is the bid. Okay, so let's just run this analysis. So here's what it shows us so far. So this here shows us that it'll cost $4.30 if we did it at these prices. This showing us the bid and offer. So this is the current bid for this spread. This is current offer. So if we're buying it right over here, this is the midpoint. And we went over this, but those are important because you want to see the width of the market. Where are people right now willing to buy it? Where are people willing to sell it? How far apart are the buyers and sellers? Right? How far apart are they? And and this is important, number one, to take into consideration. If you're trading options, you're trading asset, securities, risk assets. Part of it is that when you enter in a trade, right, you're committing capital, you're committing investment capital. Here it's for 2 days, but you're committing capital. And now when you're doing that, you need to know, well, what is the fee of entering and exiting? If I change my mind, if I find a different opportunity that's better, right? If I miss uh interpreted something, or my research or if I found another piece of information, well, what is my cost of exit? So here it's 60 cents. If you're doing it at 4:30 and you immediately need to get out at 3:70, you're talking about 60 cents. So do the percent on that. It's a significant fee, right? So that's always something you need to consider pre-trade. This is a pre-trade analysis. Also, you want to see, okay, if it's that wide, then maybe I like the trade and I'm willing to hold on to it, or whatever capital you might want to try to put in a bid that's in between that market, right? So anything lower than 4:30 is better for you, right? When you're buying something, the cheaper you could get it for, the less, right, risk you have on, because the less you could lose, right, the better you, and the better potential return. So this is part of the execution. Here, what this is showing us here is, it's not exactly a back test, because remember, back test is you're taking some kind of a strategy and doing some actions, right? But what this is showing us is based on the historical stock behavior in NVIDIA, right? Just based on the historical stock behavior, if we looked at this call spread, right? Because we know how many days are left till expiration. We know how far away these strikes are. If we took the historical stock behavior, on average, what would this spread be worth at expiration? Right? That's what this is doing. It's taking the historical stock return distribution, taking the average end value, and says it's $5.24. Well, if we compare it right now to that 4:30, that looks like, okay, it's below historical. So in theory, in the long term, right, if stock behavior matches, if the historical stock return stays the same as before, then in theory, now you have a edge buying it under that average. That doesn't mean every time this is 520. This is an average. Another way we could look at it is say, okay, if we looked at history, because it goes to, like, I think this what might be the question, can I look at history to evaluate, right? The historical data. Another way to look at it is say, okay, forget about the stock behavior for a moment, and let's just look at the historical option implied volatility, right? Because we have two options here, right? On two different strikes, right? So we have a strike 910, we have a strike 920, and there's probably some kind of a implied volatility skew, right? Like if we look it up, here's 910, you could see it goes from 53 to 54. So about, it's like let's say one click skew right now. So another way to look at it is say, okay, if we took historical snapshots simultaneously of all the markets, and then we compared those markets to each other, right, and took the average, right, we'd use those historical implied volatilities, plug them into the binomial Black-Scholes pricing model. So on average, what is this spread typically on average would trade for? Okay, so remember, we're using all the implied volatilities, and we could go back and look at the data in here, but this is the summary. So based on the summary, on average, typically a spread like this trades for $4.46. The market's $4.46. So this is below the average, right? 430, 16 cents below the average. So, from a historical perspective, the spread itself does not look expensive. That's what this is saying, right? From a historical perspective, this spread does not look, expensive. Probably looks more that it's trading on the, cheaper side of things. This is the sensitivity. Down here, this is what it looks like at expiration. So this is your payout diagram. And here we could see what this spread did yesterday. So if we just wanted to track these two options, right? This spread, how did it look like yesterday as the stock implied volatilities are moving around? So you could see that, it started out up here. Then it came down, could be because the stock price was coming down. Towards the end, it climbed back up, to around here, 430. Right. So that's how the price chart looked yesterday. If we wanted to look at a historical chart going further, we could go back here, and this gives you historical premium, what it looked like historically. So you could see here that this particular spread, right, if we go all the way back here in history, started out January 20, it was cheap, but that's because probably the stock itself was way lower than here, right? We know that this stock, NVDA, has had a really big run up, right, into earnings and after earnings. So here we could see this is what it looked like. It went from all the way down here, this 9 cents, 11 cents, you could see here. And here's what the stock was doing, right? So we have the stock here. It was $600. So you could see the stock, how, climbed from 600. So this particular spread, went from 9 cents as high as like $5.45, came back down to $1.60. So this is historically how this particular spread behaved. But you can see here it's not a back because this is the stock, right? It's following with history with the stock. And this is what the implied volatility did. So what did the implied vol do in these two options? Well, January 25th, it started out, you can see here 47, 48, and it kept climbing and climbing and climbing. And what happened here is probably it was, I think, earnings, right? So both of these options going into earnings, the implied volatility looks like it's been increasing. After earnings, they dropped off, right? Back down here, and now they're kind of came back up a little bit. So from a historical perspective, right? From a historical perspective, we could kind of see what this spread did. In relative terms with the stock and with the implied vols, right? Now it's all in front of us, so we could kind of like now learn from the market dynamics and behavior of what this kind of looked like. So coming down here, we could look at the distribution of returns. So over here, if we looked at how this, based on how the stock behaves. So if we took a 2-day period, right, because there was, 2 trading days left. If we looked at 2-day period, how did the cumulative returns do over a 2-day period? So you could see here, this is the distribution of stock returns around 0. We had stock, there were 3.7% observations that were between 7.5% and 8% up, right? We had some outliers here. There's, up 21%, down 13.5%. So this is how the stock behaved over a 2-day period. This is using, I think, 4 years of data, right? We have 4 years of data here. So, the data tables are below. So if we looked at, these historical return distributions, then we applied those to the option values, right? So this is how the option value and the option values look like. But here's the percentile rank. So if we looked at $4.30 and we applied these distributions, we'll say, okay, using these historical distributions, what we see is that this spread would have made it above $4.37 54% of the time, right? So 54%, I think, what do we have here? 241 observations. So 54% of the time, the spread would end up being more valuable than $4.30 because the stock moved in 2 days by enough percentage to cover that cost, right? From now, that's what this is saying. So let's take a look at all the, so here, the highest 100% of the observations were less than $10. So $10 was the most this would be worth, which makes sense because it's a $10 call spread. It can't be worth more than that, right? Not
AD?
10. Yeah.
Lauren is asking stock return distribution is over which period?
2 days.
2 days. There you go.
Right. It's matching this option, right? So it's matching the remaining days to expiration. That's what it's doing, right? So it wouldn't make sense to put 10 days in this. Now, if we change the expirations, it will change the period. So this is matching the options that we selected. So over 2-day period, 2 trading days. Maybe I'll add that maybe for more explanation. What we're trying to do is not to clutter it too much with stuff. But maybe I'll add that as an explainer. So then, if we're looking at this 430, we'll say, okay, well, what percent of the, what percentile is this? So we 54%. So we could see that 50th percentile. What does this mean? 50th percentile means if I took half of the end values, based on, applying these distributions, if I took half of the end values of this strategy, half of them were above this price, half of them were below. So $7.49. So you could see there that quite a bit ended up, on this side of the Fed above the 430. It went up enough times, and it makes sense, right? Because 54% we have. So we could see that quite a bit, ended up higher than $7.49. 25%, if we put it in a 25% quartile, the 25% of them were already below zero, right? So you could see here, like there was 42% of the observations were that this thing's expired worthless because the stock went down, and both options expired worthless. So that's how this particular call spread looks like, and it's not, it's not quite a back test because, again, back test is like, you're defining like strategies and actions, but it's a historical, it is looking at historical data and applying these benchmarks to this spread.
All right, perfect. That's right at the opening bell, D. Awesome job as always, June. I hope that helped. If you do have any follow-up questions, again, we can, anytime anybody wants to ask a question live, I put the link at the beginning of the episode. You can come onto the Zoom and ask your questions live. So that's always a possibility, June, if you want to come back on tomorrow. Great job, Dima.
Great. All right. Thanks everyone for joining. Stay safe out there. Have a great trading day, and I hope to see you guys